Welcome, everybody. Good morning, afternoon, whatever time it is with you. It's a nice, balmy afternoon in the UK here. So we're here today to chat to Taylor Brent, lead protocol engineer for Reserve. And first time, I think, for a voice Q&A. So we're really excited to hear about what's been going on and his take on all things Reserve. We're going to aim for this to be about an hour. I usually say to DM either me or Reserve for questions at the end, but I suspect we might not get much time for that. So we'll just play it by ear and we'll crack on and start, if that's okay, Taylor.
Good.
Okay, so we've got a few questions to go through with you. But there's one actually that I'm really keen to hear how you found out about Reserve and how you joined the team. I know I'm going to spring that one on you straight away. But if you could just tell us,
no, please,
how you came to Reserve. That I'm sure people will be dying to know about that.
Yeah, sure. So some background here. So the year is 2017. I don't know if everyone remembers that. I see something funky's going on with my audio here. Let me see. Looks like I'm transmitting though. The year is 2017, and this is the Bitcoin run up to 20K. I'm sure most people remember this, or at least those who were around then. I'm working at a place called Impossible Foods. This is a fake meat company, one of these like plant-based, as distinct from clean meats. This is plant-based meat. So sort of trying to use not the growth process that you would normally use for like a meat cell. Okay, I can tell something weird's going on with my audio. Can I get a check that it's going through clearly?
Yeah.
There is no issue at all.
Okay, great. There's not in and out issues. Is that right?
No, I think it's the Twitter Spaces app that lags.
Okay, gotcha. Okay. Anyway, it's 2017, and I'm spending some of my time thinking about like what I can do to impact animal welfare. Sorry, my audio is completely messed up over here. Let me change my audio situation. Apologies.
This is where we play interlude music.
How are we doing here? Is this better?
Yeah,
that's still fine.
Okay, great. So yeah, in 2017, I was really excited by, or at least roped into crypto by the price action that was happening. I actually got my start by, I first wrote a ARB bot between Poloniex and Binance, actually. That was my first foray into crypto. I didn't really know what I was doing. I didn't know what I was doing with markets either, to be honest. It was kind of a learning time for me. And right around that turn of that year, a friend of Nevin reached out and was like, hey, here's our white paper for this crazy thing we're doing. Do you want to come work with us, at least talk to us? And I checked some of the materials that Nevin and the group sort of like were sharing to represent like the kinds of thinking that they're doing. And couldn't follow any of it, to be honest. Right off the bat. Reading this white paper, and it's the original seigniorage shares design, right? So this is, stable token, volatile token, volatile token, absorbs the volatility and takes the risk. This is basically the Luna model. There was some partial collateralization here. I think it was 70%. All right, I'm back.
Okay.
Don't know what happened there.
No, not sure. The vagaries of the internet, I think.
I'm supposed to understand this.
As I always, because I'm in IT as well, I always say when we've got a Teams meeting or something, and someone's feed goes down, it says, "Well, it's a good job we're all in IT, so we know exactly how to fix all of this."
Okay, so where did I leave off there? What did you guys hear me saying?
Okay, you were at 70% collateralization, I think, the seigniorage.
Yes. So this is back in 2017 in our early days of thinking about how to build a stable coin. We still thought something like the seigniorage shares design would work. I could not understand the white paper. I didn't really know how to think about it. It was all very confusing, reading about one coin being minted when the other would go down and trying to figure out, okay, what does that mean about the supply? and so on. But the one thing that was pretty clear was this is all very interesting. And basically for the next like 6 to 9 months, I could not stop thinking about crypto. And a friend of Nevin eventually, at the end of 2017 to mid 2018, I could not, and I see my audio just didn't transmit for a while there. Great. I could not stop thinking about crypto, even though we were sort of post a lot of that price action. And Nevin lured me in. I'd say I got nerd sniped, basically. This was a problem that I couldn't understand. It was interesting. It was going to pay well. I was going to possibly be able to impact the world in a pretty significant way. So it was kind of everything I was looking for, to be honest.
Yeah, it seems a bit of a no-brainer when you set it up like that. Okay, so Braden, I think you've got the next question, because I snuck in with a secret one there.
We're all pretty excited to see mainnet launched, and can keep up with the development on the dashboard. What is left to do for mainnet, in your words?
Yeah, great question. So, the first thing I want to say is kind of talk about how our mainnet launch is kind of like the opposite of like the ETH 2.0 launch. So what do I mean by that? So the ETH 2.0 launch, they're actually, like, one reason it's been so postponed and it's so much effort is actually because they're swapping out the engines in flight, right? So there's sort of this moment where, okay, we've reached block height X, where that's determined by some total terminal difficulty, and now we're on the new chain, right? So we're sort of in a very opposite situation. There isn't this like binary switchover moment where, suddenly mainnet is live and something. Instead, we sort of have these various transition points. So to name a few, like you can imagine the backend is deployed on, when I say backend, the actual protocol is deployed onto Ethereum and is running. Then there's sort of, okay, there's a front end that someone has deployed that you're able to use to access it. There's going to be a point in time where we're going to have a bounty, multiple bounties, live for hopefully a pretty long period of time, actually. Some sort of beta phase. Nevin can say more about exactly what this is all going to look like. And then there's some sort of long, far-off promised finish line after all of this, where, we're able to take down the bounty. Maybe we leave the bounty up anyway, but we sort of declare this is no longer in beta. Maybe we're more comfortable to put our own money inside whatever RToken exists. But mainly, there's multiple transition points here. So what is left? So that 90%, 91%, I think we're at 90% this week. Yeah. Figure is our best effort to denote, what a binary like switchover point is in this whole process. So what's going to happen there? So what's done on the work side? So we've had an implementation. We've had what we call a release candidate. Basically meaning, this is a thing that realistically we think we could deploy onto Ethereum mainnet, and we don't expect it. We don't know that it will blow up, right? It doesn't mean we know it'll work, but we at least have some guess that the thing will work. We've had that for 3 weeks now, 4 weeks. And there's some auditing stuff that's going to be happening with that. Some of our own checking as well. Basically, we'll be auditing our own code. And we have a few more advanced tests to write. But overall, we are here in that finish line. We're approaching the finish line. The backend code we've been pretty confident in for a while. There will be likely minor changes, and really we don't want to move to that point where we're sort of giving everyone the all clear and saying, we're comfortable putting our own money in this thing until we are very, very confident that nothing is going to go wrong, right? And even then, you can only be so confident. So yeah, what is left to do? Basically, like, shoring up our own belief in the thing. Like, we need to become convinced that if we deploy this, it is not going to break. Our best guess is we are something like, actually, I don't want to give a exact time estimate because that will backfire, no doubt. Yeah, let me leave that unsaid then.
I think the political answer to that would be 91%.
Okay, great. Yeah, 91%. Do the math, figure out when we started, then you'll be able to back out an answer for when we'll finish.
Can you hear me now? Am I back in the room?
Absolutely.
Yes. Okay. Fantastic. Right. Thanks very much for that. Just on the to go to the other side of that, you do have auditors on a retainer. So I don't know whether you've had any experience of an audit on code. How long do you think that they will take to test the code, to check for what they consider to be vulnerabilities, strange things, etc.?
Yeah, so we have a couple audits that we'll actually be doing, or a couple audit teams that we're working with. I can't give any details right now as to sort of the state of that or what we have planned, other than just giving that high level. How long will it take? I mean, the thing I'd say here is it's not the case that the auditing is all lined up to happen after we hit 100%, which is sort of what I'm getting that this question is maybe getting at.
Yes, that's fair.
Yeah, so that's not quite the case. There's going to be audits happening throughout, right? So towards the end, ongoing, after that 100% point, we've been trying to get every audit firm that we can to do an audit of it, where that is a difficult task in crypto. It's getting easier, after the crash the last 2 weeks.
Yes, I can imagine.
Yeah, I don't know if I answered that question, but it doesn't come after the 100%. It's an ongoing thing. Right. There will be multiple teams doing the audits. Some are going to be up to a month. Some are going to be 1 to 2 weeks. It sort of depends on how much we've been able to convince that team to engage with us.
Right. Okay. And so, just thinking off the top of my head, would you consider some sort of dashboard for that process as well, to kind of give a weekly update of how audits are going or something? I don't know. I'm just thinking.
Yeah, that one's interesting. There's a little more like keeping behind closed doors that we want to do with the audits, and the reason for that is just how to say this. The audits are really information we're trying to get for our own feedback, and we will generally release them to the public at a future point in time. So yeah, I really can't say anything very useful here, unfortunately.
Okay, no, that's fair enough. Yeah, best keep silence on those kinds of things. Okay, I'll hand you over to Braden for the next question. Assuming we've got Braden here.
Yes. Hey, so what has kind of been the most challenging part of building mainnet?
Okay, and then here, the low-level engineering tasks, sort of higher level, the whole package zoomed out. I hear build here, and it's like, well, in my world, build is sort of everything that I do, but you also might be referring to a lower level, actually writing code, which is not what we spend most of our time doing, right? Surprisingly.
So because in code terms, there's quite a lot of code, but not millions of rows of code. So I'm guessing that the harder part was coming to a logistic framework which you could implement in code.
Yes, this is pretty much right. Yeah. So in terms of how large our project is, we have about 5,000, 6,000 lines of code, source lines of code in our repo right now, I think. This is on the higher end of complexity relative to most projects. If I sort of think back to what I see as more pure, or they're sort of trying to do a smaller thing, DeFi primitives, things like Uniswap pools or MakerDAO CDPs, they're sort of trying to make a smaller primitive. So they actually don't have as many lines of code as we have nearly. That said, what you said is totally correct, which is that the code that we write is not the hard parts. The hard part is actually, can we even come to a understanding of the problem that is easy to think about and can be translated into code without any errors. And that's actually the hard part, surprisingly. I thought I understood this problem quite well, something like a year ago. And the reality was there's still a lot more to figure out. A lot of what we do is going back and forth on the protocol team, just ideating, right? Just talking about what are even the right concepts to use to discuss this. And which seems, if you're outside the computer science world, this seems kind of silly. It's sort of like you guys are spending all your time talking about like how to think about the thing, or just like you don't even know what concepts to use, like how elementary. But the reality is actually like if you can decompose a really complex problem into some set of orthogonal dimensions, and you have the right dimensions to think about it, it becomes much easier to think about the problem. It feels natural. It feels hard to mess up almost because you sort of like built your guardrails in the right way. So I'd say the hardest part was getting to that point, honestly. And we have this like fairly complex system with pretty weird language. You know, you hear us talk about like the target unit and target amounts, and then there's the reference unit and reference amount, and then there's collateral tokens and collateral amounts. And it all sort of seems very needless, I'm sure, from the outside. But if you dive in and look at the problem, I think this is basically the like minimal set of dimensions that you can reduce this, general stablecoin problem to, that still makes sense and allows you to capture the entire space that you're trying to without introducing an additional dimension that you don't need to think about, right? So this is sort of the minimal set, we think. And I think we're still refining the language to communicate this. We have target unit, target amounts, I think is pretty difficult to make work. I think one thing we'll be doing is probably having a conversation with the community to figure out what do we want the interface for the public to be when talking about this system. You know, should it be the lower level thing that we've been using as engineers, which is like highly mathematical? You know, you could write like some summations that, you know, express exactly what the sort of aggregate target unit is as a function of all the underlying target units, or is there something simpler that we can use to talk about the system? So yeah, it's sort of a roundabout answer, but trying to get to the point that there isn't like a particular task or a particular piece of the code that's difficult to produce. It's actually just making sure that you're very confident in exactly what pieces of code need to be written, and you know how they interrelate, and you know that you've broken the problem into the correct set of dimensions. And that's just taken quite a long time to get to. And then final thing I'll throw in here, there have been some surprising interactions with governance, actually. I think I wasn't expecting some of this. I was expecting governance broadly to be very difficult, and that's why our plan is, I think we've said as much as this. Our plan is that at mainnet release, there will be a governance that gets, when you deploy a new RToken, you sort of receive a whole governance system for free. And that's going to be modeled after the Compound Bravo governance system, which is basically naive token voting. And anyone who's been in crypto for a while knows that there are problems with naive token voting, right? We do too. That's not and yet we are still going with it, right? And why is that? That's because one of the things we're going to do after mainnet release is actually allocate a pretty significant portion of the team to thinking solely about this governance problem, where we hope to not only make progress on that for our own team, but hopefully like push the whole space forward a little bit there. The only one really doing innovation in this space, I would say, is like Optimism, right? You hear about Optimism's bicameral system. That is really like the first iteration beyond pure naive simple token voting that at least I have heard about at a large scale. So there's a lot to figure out on governance there. And there's a challenge around how do you govern multiple RTokens in a way where one RToken cannot be attacked. And in particular, we have these unstaking delays around RTokens. There's sort of frictions for going in and out of the RToken. So imagine, you have these like different physical spaces you're trying to like maintain or keep safe. You have to keep them all safe at once while at the same time, sort of having equal. The rules for play in this governance game have to be purely public, right? The attacker has to play by the same rules as the defenders. And exactly how this interacts with, different RTokens having different amounts of capital locked into them and having different staking pools associated with them actually turns out to be fairly complex. So another interesting, challenging part has been the interaction between the economic protocol and how governance is going to have to work. We've been surprised at the amount of interaction there, I would say.
Okay, cool. That's great. I also, just to chip in and follow up on that slightly, you as you know, this protocol's kind of novel. It's new, so you've had to come up with language and terms and theories that are new. But also, in the grand scheme of things, this is still a product. So you have to define the beginning and the end of the product. So I'm guessing that you could have implemented a lot more functionality than you did, but at some point you've got to say, we need to be able to do X and execute it. Because I'm sure there are many other ideas that you had that you thought, that would be great to have, but I don't think we can put it into, let's just say, version 1 of the protocol.
Yep. Yeah, so there were a few of these. Are you interested in hearing about them? What exactly is the question?
Go for it.
Yeah, sure. So one of them, this is probably the largest one. We'll be trying to say this pretty loudly for the whole community to understand, but I'll say it loudly here yet again. So collateral in this V1 is only able to be monotonically increasing with respect to its target unit. Okay, so that's a bunch of jargon. So what am I even saying? What I'm saying is if you have a collateral that's backing an RToken, and you want that collateral to you want that RToken to be something like a USD RToken, right? You denominate that RToken in USD. You generally expect its price to go up with respect to USD. Well, it turns out that in the protocol that we've written for this release, you cannot use something like ETH, which goes up and down with respect to USD. You cannot use ETH as the collateral for a portion of the basket that is intended to be targeted to USD, right? And the reason for this is that if there any depreciation in this version of the collateral is viewed as default and viewed as the reason to swap the collateral token out. And without this, what would actually happen is you'd have your ETH depreciate. This would cause ETH to be purchased, and the people who would pay for that would ultimately be the RSR stakers. Then when ETH appreciates, you'd actually see some portion of that value flow to the stakers and the other fraction flow to the RToken holders. And then this is actually bad because if you sort of repeat this entire loop over and over, you can see it's actually just a value transfer from the stakers to the RToken holders. So it actually just breaks the fundamental economics if you put a collateral token in the baskets that can't be guaranteed to just be going up with respect to its target unit. So this is a big one. We had to cut this because, well, it makes the protocol significantly more complicated. I am hoping that we'll be able to do this, in a somewhat short timeline. Like we can start thinking about the problem, within a year or something of the V1 release. But it's going to be, it's sort of like Uniswap, right? Uniswap, when they built Uniswap V1 and V2, at least this is the story I've heard. Towards the end of V2, not even towards the end, I heard towards the beginning, they knew immediately what V3 was. Right? They knew, oh my gosh, the sexy thing here is concentrated liquidity, right? We've sort of, the V2 that we're creating is an instance of a broader reference class. And we could actually support a much larger set of use cases if we could just do this one thing. So it's actually very similar to that. We spotted something that could make the protocol much more general and much more interesting, but would be much more difficult and just make sense for a following release.
Oh, wow. Oh, that's brilliant. Thanks very much. Braden, are you going to hop in now, or is this me? I think this is me. So,
yeah, you took my question.
Did I? Oh dear.
I'm kidding.
Just going back to when you were doing the intro, Taylor, you talked about the seniorage share system. Yes. And so, when was the light bulb moment that you went, do you know what? I think this is just really risky, and let's kind of try and connect that into the lunar and Celsius situations, sure. Let's call them.
Yeah, situations. That's a word for it. So let's see. In 2017 and 2018, yeah, like I said, in 2017, before I joined the project, and I was reading the white paper we had at the time, the white paper basically was a seniorage shares model. You can think of it basically like Luna, where the collateralization instead of Luna's 0%, where eventually they added Bitcoin, so maybe they're like 10 or 20% eventually. We were going to say, well, let's allow our collateralization to fall to 70% in the long term. So the idea was you start at 100%, where every time a dollar is put down, you keep the whole dollar. But as the stablecoin grows and grows and grows, when a dollar is put down, you only keep 70 cents, and then you take 30 cents as revenue, right? And we thought this was like a kind of conservative approach. Like maybe we could use this to make senior shares work. And all of 2018 and 2019 was basically having conversations internally to get to the conclusion that we just can't justify this conclusion. We what we do internally often is we look for an argument for something, not in like a motivated reasoning type of way, but like in a way of, can anyone present, a verifiable claim for why we should believe this thing? Where obviously like the search process of coming up with that argument is really difficult, but the verification process is actually pretty cheap, right? You can just figure out, okay, has someone presented a valid argument that can convince you of some conclusion? And we were never able to convince ourselves the conclusion anything less than 100% backed will work. And this looks kind of like Frax, actually, if you zoom out. Frax, the way it works is when it's very small, they keep 100% of the dollars that gets put into it. As it gets larger, they decrease the collateralization ratio over time. We ultimately think even that is too aggressive to work, though we do think like it on much longer timescales. That kind of thing can live much longer than Luna, which was no percent backed. Okay, so tying this into Luna, and actually maybe later I'll provide a way to think about our protocol to relate it to the other stablecoin protocols that'll be useful, I hope. On Luna, so yeah, like I said, Luna is just the model of you give me $1 to create a new stablecoin, I take that dollar, and instead of leaving it in a vault, I use it to promote further adoption and hype around our ecosystem, right? That is what the Luna model is. And it's incredibly reflexive, right? And that's in both directions. And that's because, every dollar, you're sort of double counting the value, because you look at a dollar that is in the market cap of UST and you look at a dollar that's in the market cap of Luna, and you say these are different, these are different pools of value, but actually they're like highly overlapping, right? So that's sort of the problem you run into. And yeah, I guess I don't have to convince anyone that Luna doesn't work. I think we all know that now. It's kind of, people don't want to hear you, don't want to listen to you when all you're saying is, hey, this thing doesn't work, you're going to hurt people. Like, it's actually just really abrasive to have someone tell you that some protocol is not going to work and is going to hurt people. Like, it's actually just much easier to believe, like, no, the thing is going to work, you're the bad guy for like being a negative Nancy here, like have fun being poor and retarded, like Do Kwon style. I don't want to dump on Luna anymore. So let me move to the Celsius and generally like what is happening with crypto in this moment question. So my understanding of this, at least what it seems like, Luna didn't cause this whole crash and various liquidation cascades that we're seeing. Something else sort of caused it, right? You sort of had the downturn in the market broadly. So macro broadly, 75 basis point raises. And then that triggers the Luna collapse. And then the Luna collapse triggers a whole bunch of other collapses, because it turns out a whole bunch of other people were relying on some portion of the Luna ecosystem as collateral for the leveraged investments they're making elsewhere, right? So this is sort of what Celsius was. The thing I'd point out here is just Celsius is a centralized lending platform. Like, this is why we don't like centralized lending, because it's not transparent. It's actually opaque. We don't know exactly what was the full set of their investments, how was it collateralized, who were the counterparties, right? Whereas if this is on-chain and it's DeFi, well, I can just look at an account, see how close it is to liquidation, see the counterparties they're interacting with, and so on. So yeah, I just say, like, I hope we don't allow this collapse to allow us to think that DeFi in the first place is the thing that's causing this. Like, the thing that's causing this is the same thing that we've had in all markets, traditional and crypto, for a long time. And DeFi is a move towards keeping that more exposed and at the surface, so that these kinds of crashes can be recognized much more quickly, right? Like, an interesting question is, right after Luna collapsed, were Celsius and Three Arrows Capital insolvent, right? The answer is like maybe, okay, so maybe prices were actually kind of high at that moment when they collapsed, and the answer might be no, they weren't insolvent at that moment. But the point I'm trying to make is that they were insolvent pretty quickly, and then we don't hear about it as the public until much later on, right? So there's this long period of time where sort of the whole market is like much higher up than it really should be, given the fact that this large disaster has happened. And turns out there's a bunch of insolvent market participants that no one's really able to track because this information is behind closed doors. So we eventually do track it by watching, MakerDAO CDPs, and we can see the Celsius CDP needs some collateral added to it. And that's sort of how you track down that there are these problems in the first place. But yeah, basically, I'm quite thankful to DeFi for giving us the tools we need to reveal this kind of thing. The size of the crash is, one other thing here is just that, and this is a point like Hasu has made, the Luna crash, it's bad at the current scale, right? But I think we all kind of believe that we're going to recover. It's like, well, yeah, regulators might come in and make some bad regulation. Crypto is going to get a bad name for a while. But we kind of still believe the thing will probably work in the long term. At least I do still. If this were 12 months later, right, I don't think I would feel that way. I think if this were 12 months later and Luna were 10x the size that it was when it blew up, this would be an entirely different story, right? So we'd be talking about banning crypto entirely, and the systemic risk that crypto presents. So yeah, I just would really like to see, I sort of view the market population, it's sort of like this is actually the adaptive markets hypothesis model. So you have this idea of like, there's different populations of people employing different strategies in the markets. And what Luna was, it's this like massive evaporative cooling event where you remove all these strategies that were actually quite dangerous and risky. And with that comes an update in people's like understanding of how to act in the future, right? So people will be less likely to fall for something like Luna in the future is the idea, right? That's what I hope is the case. And I think when the crash happened, there's a good chance we will be able to learn this lesson correctly and not make another one of these in the future and not allow it to be nearly as big. We wouldn't have had that affordance if the thing had gotten 10x bigger than it did when it collapsed. That would have probably been it. Crypto, would be gone for 5-10 years or something, or have to move out of the US or something. So I just say this whole thing is super dangerous. Like, I'd really like to see people a little more down to invest for the long term rather than sort of like 3-3. If we all act together, we can all make money. When that's like rarely the case. That's only true when value is being created, right? So it's I would like to see a bit less hype beast sort of profit-seeking behavior in the markets and a bit more understanding that there is no free lunch, right? And in fact, there's almost a inverse relationship between the systems that are most profitable and exciting and reflexive and price go up in the short term and systems that are actually coherent. Like, actually, there's a straight up inverse correlation here. The systems that are coherent keep more of the money inside them and seem less exciting, right? So sorry, I said a lot there and it was a bit long-winded. What are my main points? Luna could have been a lot bigger. That's very scary. Celsius was ultimately a centralized platform, not decentralized. Decentralized still gives us what we want. Yeah, and I guess also we don't know the end of the contagion, right? We're all here. I think we're all in the same boat where it's like maybe things go down another 50% because maybe there are another few large market actors who turns out are insolvent and we just don't know yet. So I'm right there with you. Maybe this is the bomb, maybe it's not. I don't know. It's really crazy that all this happened so quickly.
Yeah, at least it's not being packaged into junk bonds and sold as mortgages. So
exactly, right? Yeah, at least you can see what's going on. Mm-hmm.
Yeah, cool. Okay, Braden, I've eaten all your questions, but you definitely get the next one.
Yeah, you're fine. Hey, so no, that was pretty good here. Thank you, Taylor. Okay, so we all know, mainnet is coming up, and obviously Ethereum merge is coming up as well. Does the potential timing of the merge affect your approach to launch? Is there significant effort on reserves and to participate in the merge change seamlessly?
Yeah, good question. So this is totally by chance. I don't know if you guys have noticed. Our release has kind of been pushed back, like pretty much in line with the merge as it has been pushed back. Initially they were planning early 2022, and that's also what we thought. We thought, first few months of 2022. And then we pushed it back to mid-year. They pushed it back to mid-year. Then they pushed it back to, I think we actually have a date now. Something like mid-September is actually when it's going to happen. I think they had to commit recently. Some sort of number had to be put forth. I think, okay. So you can back out from the total terminal difficulty that was set roughly when that's going to happen, assuming no changes in hash power. So it's just chance that we're sort of having the same timeline as them. I think that comes broadly from the fact that it's really hard to make estimations in engineering. You can only ever estimate about you can try to estimate about what you don't know, but it's very difficult to. Anyway, Reserve does not have to do anything to partake in the change seamlessly. This is actually why the merge has taken so long to do. It's because they're doing this swapping out the engine in mid-flight thing. The level at which we interact with the system, writing smart contracts, it's just totally orthogonal or separable from the question of what the underlying consensus mechanism is. So that's really great, right? This is actually like one of the reasons all the application developers on Ethereum are like, this is why we're on Ethereum, right? It's because we understand that the devs actually are responsible and know what they're doing. And in an instance like this, yes, they're going to move slowly and people will have gripes and gas prices are high and so on. But as an engineer, like, they're doing the important thing, which is that they're making that transition not require any change from anyone else, right? Other than if you're a miner or a node operator, in which case you have to update your software. But yeah, so for Reserve, no, we don't have to do any work at all. We will be the beneficiaries of the new proof of stake chain for free just by deploying onto the proof of work chain in advance. If that happens, maybe deployment happens to be right after the merge, so we deploy onto proof of stake chain, but again, it's all the same.
Cool. That's good to know.
Thank you.
On the ETH question as well. So transacting on L1 ETH, not very good. Expensive, etc., etc. But I know you've been looking at L2s. So in your opinion, how long do you think it's going to take for an appropriate L2 to be identified for on-chain transactions? We know that privacy is a major factor. You can't just walk into a shop and somebody know your entire transaction history, but also finality and speed. So what are your thoughts on the L2 situation, and what kind of volumes would you expect to be able to throughput? Because let's just say Reserve does become a worldwide phenomenon. You've got credit card networks like Visa that can settle 5,000 transactions a second. Now that's everybody using a credit card network, but maybe if a Reserve is to aim for maybe 1% of that, that's still quite a lot.
Yeah, I'm not too worried about this, and that's mostly coming from an intuitive judgment, I guess. I'm realizing I don't actually have a robust numerical quantitative argument why L2s will be sufficient for the kinds of throughput we're looking for. I think it's just like when I've looked at the L2 scaling problem, they're just dealing with you're solving a much different question when you're building an L1. Okay, you kind of have to bootstrap truth from the ground up, right? That's the fundamental question you're trying to answer: is what is true about the world at this moment, right? And you don't have like an anchor or a backboard or a backstop to lean on to tell you what's true. So you kind of have to spend all your system resources just building a system that tells you what's true, right? And this is when people talk about the consensus layer as being distinct from all these other layers. This is what they're getting at. So layer 2, I sort of see it as like they have such an unfair advantage over L1s. You can just do a easy operation to figure out what is true by consulting the L1, right? And this means that you can ask the L1 to verify a zero-knowledge proof, right? And that zero-knowledge proof can actually come along with this whole suite of transactions that have been, put inside the zero-knowledge proof. And the types of scalability this unlocks, I just think it's really crazy. I expect this to change every 2-ish years or something for the next few years, and for these gains to be order of magnitude gains, compounding on top of each other, right? So that's sort of how I expect this to turn out. So I kind of just assume there's going to be enough L2 block space for us in a future world. So what does that look like? So L2s can be general and they can be special purpose. If it's the case that I'm sort of wrong and it's actually much more difficult to get an L2 to size, then we move to something much more like a special cased L2, right? So something that doesn't have smart contracts. It just knows how to do, 5 simple operations. One of them is an ERC20 transfer, right? So we kind of know we have that option as a backstop. And then if that doesn't work out, I'm personally most excited for the ZK EVM solutions here. So yeah, I guess I'll say a little bit about that. So if you can take the whole EVM and put it inside a zero knowledge proof, right? So what you do is you actually implement a circuit for each of the opcodes that exists. There's some teams working on this. This is the kind of thing that a year or two ago we just thought wasn't possible. We just said, like, this is crazy moon math. Maybe in the future when we have bigger computers, blah blah blah. Instead, what we found out is like, well, teams are already doing this and figured out how to make it work. And ZK Sync, for example, is pretty bullish about this. They're claiming they have a way to do this that scales. Another team that I'm blanking on has built a really great ZK EVM that was on the Zero Knowledge podcast recently, is doing it. Okay, so sort of going round and round here, but what are you guys trying to get at here? We're going to hopefully deploy onto a full general purpose ZK EVM chain because that will allow the full diversity and complexity of DeFi to be present on it. And then as a fallback, if that doesn't happen as early on as we would like it to, then I'm very confident the special cased L2s will be sufficient for us. I mean, I basically think even today we could move on to some special case L2 and be okay. Final piece here on privacy. Yeah, so privacy is a major factor. This is one reason I've been watching Aztec Network a lot. They seem to be like the most serious private L2 that at least that I have been able to track. And it's just a superior model to Tornado Cash for reasons. Anyway, so obviously it's very important to have privacy. The major difficulty there is today, Aztec and other privacy L2s can only transfer sort of preset size chunks of tokens. So, you can transfer 1 or 10 or 100, but you can't go pay exactly how much you need to pay to purchase your coffee, right? That's sort of the breakthrough we're waiting for there. So hopefully that's an overview of the L2 space. And then we're also open to bridging to other chains, even if they're not L2s for Ethereum, right? It just happens to be that the L2s for Ethereum are what I expect to scale the fastest. But if there are interesting side chains, especially interesting privacy side chains, I wouldn't be surprised if we bridge there as well.
That's a pretty good segue into our next question. So like going to other chains, like Jack Dorsey recently said, Web 5.0, not sure exactly where that number comes from, but he's stating that ETH is a single point of failure. So let's say ETH slows down and the fees go parabolic.
Okay.
How does a reserve, which needs to last for 100 years, protect itself from the fate of ETH?
I mean, I'd say we've already acquired the important resource, right? So the important resource is actually the code itself, right? And with so many other chains, okay, so what does this world look like, right? So this is I'm trying to believe this ridiculous Jack Dorsey 5.0 world. Where, okay, yeah, ETH fees can go parabolic. That's totally a thing that I expect could happen. But I anyway, let's put aside exactly why ETH doesn't work out. ETH doesn't work out. If we have this code, it's already in Solidity, it's already being audited, and whatever the replacement is supports the EVM and Solidity, then, we really haven't lost that much. We redeploy there, and we're basically good to go. This is not the standard case, though. The standard case is going to be the EVM and Solidity have actually lost their network effect to begin with, right? And there's sort of some new tech that's even sexier it's easy to be sexier than Solidity. In that case, I kind of just think in the worst case, we can rewrite our code for that other chain. But I'm really not expecting this to come to be. And I guess let me say a little bit about what we're looking for in the chain that our protocol exists on. So the reserve protocol is actually a bet about having a diverse and robust set of derivatives to invest in. Okay, and it's sort of not clear why this is the case until you really dive into some of the economic analysis behind our protocol, which I think I'm going to do now because that's a useful time. Yeah, and okay, so forgive me here. This will be about 2 minutes or so. So if you look at so people have heard about the stablecoin trilemma, right? There are these three things we care about: decentralization, scalability, and stability. Seigniorage shares, highly scalable, right? In fact, too scalable. It is decentralized generally, even though Do Kwon managed to turn it into a centralized model. And its issue is that it's not stable, right? Okay, so MakerDAO, the CDP model, that model is actually quite stable, right? You're requiring liquidations to happen quickly, but as we've seen historically, MakerDAO has just gone through all of the crises quite smoothly. So MakerDAO, that CDP model, is stable and it's decentralized, but it's not actually scalable, right? For every dollar of stablecoin that you need, you have to put down something like $1.5 to $3 of ETH, right? Okay, centralized stablecoins, USDC, is scalable and stable, but not decentralized, right? Okay, so where do we fit in all this? We're sort of trying to take the best from all worlds and put them together. So what do I mean by that? We are an over-collateralized model, but we're over-collateralized in a surprising way. So we only ask people to put down $1 in order to create a new stablecoin, right? We don't require that they put down, this complex CDP, create this complex CDP position. They can just go put down $1. And then how do we over-collateralize that? We actually access this pool of RSR insurance by sort of bootstrapping that value from the expected future profits of the derivative that we're taking in. So we're taking in some DeFi derivative that has some yield built into it. That allows the holders of this other volatile token to expect to get some share of that collateral token in the future. And that causes the RSR token to have some amount of value. So if you kind of zoom out, what we have is we have something like 120, 125% collateralized system in the long term, I'm talking, where we only require 100% to be put down at the time of issuance, and we sort of get that additional insurance or over-collateralization portion relatively for free. And this allows us to have issuance and redemption be entirely decentralized, right? Just like, say, in the Luna model, if they had done it correctly. In the Seigniorage shares model, where a smart contract is doing the issuance and redemption, it allows you to be scalable, like the centralized USDC model, because you only require $1 to create $1. And it requires you to, and it provides stability. Basically, okay, so how do you get stability? This is sort of the final piece. You get stability if you have sufficient decorrelation between your collateral assets, between your derivatives that are backing the RTokens. So if you just have a single derivative, let's just take CUSDC, for example. USDC is the, let's say CUSDC is the only collateral for an RToken. If Compound or USDC, Circle, defaults, there's 100% wipeout. If you do the math, there's just no way you can expect the insurance pool to do a bailout for 100% of the backing. So what you need is you actually need something like 20% of the backing to default at any given moment, worst case. So this means that the reserve protocol, fundamentally, it is a bet on having decorrelated and diversified derivatives available on whatever chain that you are on. That's where the strength of the reserve protocol comes from. And this is actually a reason why we expect to stay on Ethereum. A lot of the talk here has been about what about these technical differences between Ethereum and other chains and so on. The technical differences are not what matters. It's kind of surprising. The thing that matters is how large is the DeFi system on that chain? Are there robust derivatives? And we don't have robust derivatives today, right? I think we're talking about the first RToken being backed by A tokens and C tokens, right? That is not enough. That's like a 50-50 split in terms of the DeFi portion, right? Half from Aave, half from Compound. And we're talking about needing a 20-20-20-20 split later on, 520s. So fundamentally, we are making a bet that there will be better derivatives in the future, and that there'll be a wide variety of them so that we don't have correlated risk in the backing. Okay, so why did I say all that? Right. ETH is a single point of failure. Yeah, where do you want to take this? So that was some background on exactly like how to think about our protocol as it relates to some other well-known ones.
That's fine for me. I mean, you got into the detail of why Reserve has taken the path that it has, what the ups and downsides of the other potential routes you could have taken are, and well, the question was kind of the Jack Dorsey part was a half joke anyway, because he's in his investment in doing things his way is obviously suits him down to the ground, but doesn't suit many other people, I don't think. So the single point of failure part is, let's just we enter World War III and Russia and China take down the internet, then we're in a pretty bad place. But I would imagine even then, an ETH-backed stablecoin is probably the least of people's worries if there's no internet in the world. So I guess you go back to trading shekels and coins and shells.
Yeah, I see. I remember where I was trying to tie this in. I was just trying to make the point that we actually we are tied to the fate of ETH to a good degree. Basically, we're tied to whichever platform has the most robust DeFi ecosystem on it. So basically, I'd see us staying on that chain, the failing ETH chain in this world, as long as the DeFi ecosystem was actually superior. And, if Jack's able to make a healthy DeFi ecosystem on his Web 5.0 chain that isn't a single point of failure and something solves the blockchain trilemma, then, we would absolutely move over there and we'd be the beneficiary of their diverse set of derivatives. But that is primarily the thing I'd say we're paying attention to, actually, just because it's necessary in order for the economics to even work in the first place.
Yeah, so effectively the value added is not necessarily ETH, it's the code and the thought behind the code, and that's pretty portable.
That's right. Yes, absolutely. Mm-hmm.
Cool. Are you okay for time? I realize now we've gone over.
Absolutely, yeah. Sorry for this late start here, but I'm here as long as we need to be.
Oh, that's cool. Okay, yeah, we've just got a few more questions then. So I'm guessing you and Nevin you roadmap out development requests and things like that on the app side as well. Because we spoke to Bakafu Ninja a few weeks ago, and he mentioned having booked in some dev resource for enhancements in the app functionality. Are you able to talk about any of those at all?
I don't have visibility into this, unfortunately. I can give you the high level, though, which is, this should be pretty obvious to most people, but we are looking to integrate the app with layer 2s in the, I don't want to say in the near future, but it's a high priority, right? This is important. And I can also say that we're actually, Nevin has announced this, we're planning to support basically a both non-custodial and custodial approach simultaneously. So for some people, we're going to have the app be, here is a crypto wallet that allows you to hold some amount of RToken in your own private wallet, Argent-like. And for some other set of people who just, they aren't going to care about those things. In fact, they want a whole bunch of other UX niceties and so on. We're going to allow them to hold it in the way that they do currently, where, we can do recovery for them and a whole bunch of other nice things that make it easier to work with. And they can still access the Reserve ecosystem and any other, sorts of yields that sources of yield that we've added into the app. Obviously that's, if you're holding an RToken in the app, then you have yield, I should make clear. So this is a bit like a savings account for people who are holding RTokens that appreciate in the app.
Cool. Okay, that's good. Well, that's plenty. We're always just after crumbs of information, and we'll take that. Okay, Braden, I think you're up next. Braden, are you there?
So that's a good question in regards to, or a good segue into the next question. So essentially, after mainnet and after developing those different integrations with other entities, is there anything else that you're particularly looking forward to in the Reserve roadmap?
Okay, so I sort of have a weird route that I'm anticipating that I'll head down here, which is I still expect that I'll be working on the reserve projects and within our ecosystem, but I kind of expect over time that I'll start to step away and be a bit more of an independent entity. So one thing I'm really excited about, and the reason I just gave that whole preface is this is something that's so crazy that I kind of don't want to put it under the reserve branding yet. But there's something that I'm quite excited for that our protocol allows that other stablecoin protocols don't. Okay. And I'll try to, and I haven't completely figured this out myself either. So I'll do that with you. You guys will be doing that with me live right now. So the idea here is, so an RToken has this ability to change its backing over time, right? And this, at first, it's sort of like, okay, well, why is that a game changer? Well, what it allows you to do is it actually allows you to swap out the backing for an RToken over time to be a representation of a liquidity position in DeFi between the RToken and sort of what was its, first order backing. So what I mean, let's imagine we're going from a world where we have CUSDC and AUSDC as the two backings for an RToken. I'm talking about we do a governance proposes an upgrade to back the RToken by an LP token between the RToken and, AUSDC or CUSDC. So there's there's two LP tokens that are backing the RToken, and they're in 50-50 proportion. And they each represent liquidity between the RToken and one of sort of the first order backings, right? So we're sort of like layering these. There's the actual collateral itself, and then we're building these market making positions on top of it. I'm really excited for this because I think I haven't seen this be done before, really. I think MakerDAO is sort of doing this with their like USDC /DAI LP token for Uni V2 being a eligible collateral that allows you to mint DAI. That sort of has the same feel to this. But otherwise, it's not a thing most stablecoins can do because most stablecoins don't have this ability to change themselves, to change what they are, right? To actually change their backing. So this is a pretty interesting novel use case. You can actually back an RToken with its own liquidity, right? And if you're, when I first started thinking about this, I was like, okay, does this even make sense? Is this even like possible? Are we breaking some fundamental like law here or constraint? I think what happens is you end up making your system a bit more leveraged. So you get some yield. You can collect that from trading fees due to the LP token and people trading in that particular pair, which of course they will because they need to go buy the underlying collateral for the token in order to mint more of it. So you sort of have this like virtuous circle going on. That's quite good. Yeah, but at the same time, if there's a collateral default for any portion of that backing, basically because you've replaced that, like every dollar of CUSDC that used to be in the backing, you've replaced with 50 cents of CUSDC and 50 cents of the RToken itself. And this creates this recursivity. So if the RToken loses some value, it sort of loses it twice, right? Because there's some portion of it that is like self-referential. So you can like model this as like a series that converges and you come to claims about exactly how the system behaves in the case of default. And we haven't done that at a low level. And that's definitely something I'm hoping to like sit in an armchair and think about after mainnet release. But yeah, this is something I'm really excited for. Just the ability to make an RToken that's backed by particular market making moves in DeFi, which is quite different from other stablecoins that we've seen today. So yeah, I hope that was interesting. That's a little tidbit I've been holding on to for about a year now. That I hope will go somewhere. I hope someone does something with that, even if it fails, because it's an interesting idea.
Well,
That's very interesting.
And we just need to wait to see if people will stake their RSR on it.
Exactly. That's the beauty of the whole thing. Yep.
I also think of these, somewhat like a managed fund. So you could say, okay, as an organization, you want to make a little bit of money out of making your own. Let's say Circle decide to go with a numerously backed stablecoin as an RToken, and they can have somebody 100% of the time managing the backing of the mix, and the governance says, okay, this guy is a professional. He's going to make changes once a week or once a month. He's going to swap out some valuation stuff. Maybe he's going to go with oil because there's a war on and the price of oil's high and this is good. But it's going to be 100 different assets underneath it all, and it almost mirrors real life finance where you de-risk by just having counter moving assets. So gold is going to go higher when there's war on, but it's going to drop low when it's seen as very safe out there. So I think that hopefully, if we get more stuff on chain, then those kinds of baskets can be available. And I don't see why that doesn't become just like traditional finance, only DeFi.
Totally. I completely agree. That's the long-term vision, just in case people don't really see how you get from this like CUSDC, AUSDC simple derivative backing to like a much more complex, robust backing. And that's basically by making the backing look a lot like what the investments of, very well-to-do, old money type folks, what they do with their money, right? And you can sort of have that be managed in this decentralized way where the staking pool is able to do the upgrades instead of a particular centralized party. And that looks a lot more exciting. Now we're talking about a RToken that, looks a lot like something that's CPI pegged, right? Even though it's not quite that, it's kind of doing a different thing. And that's kind of why I'm here in the long term, to be clear. The RToken in the near term that's dollar pegged, right? Well, at least dollar referenced. The target unit is dollars. That's interesting, and we are bringing something new to the table here in DeFi and the stablecoin space. But in the long term, it's ultimately going to be this much more diversified RToken that is that's the big play. That's the real interesting thing, in my opinion.
Yeah, cool. Okay, I think we've got one more question before we wrap up. So, your general thoughts on trends in crypto for, I don't know, the next 12 months, 2 years, whatever. Obviously, not very many people predicted this carnage, but what are your thoughts on crypto in the near future?
Yeah, so let's see. So, I mean, at first, I just want to make clear to everyone, I'm extremely biased. It is so hard for me to be bearish. Both like just fundamentally as a person, I'm like a pretty optimistic person. I kind of think we don't like have a choice, kind of have to be. And within crypto, I'm also very optimistic. So let me see if I can point to some of the things that make me feel that way. The environmental narrative change, right? With this change to proof of stake for ETH, I just think there's this way in which, as a normie, you're sort of like looking in and, all of crypto is bad scams that are boiling the ocean, right? So the moment we can change that to be like, well, actually, look, like all the space that we're building on, these like general purpose smart chains, like Ethereum, they don't have an externality anymore, right? How does the world react to that? I just think it's a game changer. And I think it'll be quite positive. Possibly provide some decoupling from Bitcoin, right? Which I think would be good for ETH. So it's just quite hard for me to be bearish. And then I guess another thing to throw in here is I just think zero knowledge proofs are the most exciting thing to happen since like Nakamoto consensus was created. It's just a massive unlock. It's just one of these moments where like you just are able to do. So what does the zero knowledge proof do? Previously, you could do similar things to that, but you relied on a fraud proof, right? So you'd make some set of claims, and then you say, okay, the game theory says if I give people a week to come falsify my claims, then I can be pretty sure if my claims are false, they will be falsified, right? And that works, but it's just like a way more complicated system. Like you're dealing with. You have multiple agents, one of which you needs to show up and be incentivized somehow to report the fraud. You have this like 7-day waiting period, right? And I'm not just referring to optimistic rollups here. Anything that uses a fraud proof is going to have some sort of waiting period like this, even if it's not 7 days. And then in comes ZK proofs. And ZK proofs are like, okay, well, I'm going to give you the same property that the fraud proof gave you, but I'm going to give it to you instantly. So it's not this asynchronous process of like claim at time t0 and then proof at time t1. At time t0, you get the claim and the proof at once, right? So you can like automatically update on that being a true report about reality. And you don't require like another, some entity that's online to come report to you a fraud, right? The math is the proof that the thing is valid. I just think this is like this changes so much. I think in the world where we're living in like a limited Ethereum chain throughput with zero knowledge rollups running on layer 2 with various zero knowledge rollups running on layer 3 off of them that, maybe don't have data availability, so they're, a lot cheaper to use. This is just, I think it's just so powerful. So it's really hard for me to look at this math and say, like, things will be bad, because I think we are right on the cusp of a lot of these systems that use zero knowledge proofs actually being useful. So people have been talking about layer 2 summer for a long time. Maybe this year it happens, and that would be crazy. And then, final thing I'll say here about crypto thoughts for next year. I mean, I also just think it's possible that we're all so excited about the merge, and then the merge happens, and then there's nothing going on, and everyone sells off. Like, that could totally happen. But again, that's not like that's not fundamental for me. That's like a short-term trend. Fundamentally, it is so difficult for me to be bearish. I mean, and that's fundamentally why I'm here in the first place. And then, last thing is that I was like born in the bear cycle, like the 2018 to 2019 bear cycle. That is where I learned most of, at least that's where I started learning about crypto, right? And it's nice, it's quiet. There's not a whole bunch of noise, right? That makes it difficult to figure out what to pay attention to. And as ETH was crashing from $1,400 to $80, I was just funneling my dollars into ETH as quickly as I could. I didn't care that it was going down. It's like that's gonna happen again. We're going to have the similar thing going on this time around. And honestly, I don't feel bad about it. Like, it feels pretty excellent. I've embraced the bear market. It's an important half of the market. Without it, we'd be nothing.
Yeah, it's a decent reset. So I think
Hold on. I have another question.
Oh, okay, go.
Okay, so on that broader crypto note, what are your thoughts on Bitcoin?
So Bitcoin, saying a thing that lots of people probably already know, but this is what I believe. Bitcoin has not solved the security problem. Bitcoin has found a short-term solution that in a late stage fiat inflationary environment does quite well, right? This sort of like asymptotic, you're approaching some sort of finite fixed supply in the long term where you have a decreasing issuance. Every time there's a halving, we decrease a bit more. That all makes a bunch of sense in the current world, and it just doesn't work in the long term. Like, and everyone knows this. I'm not saying a particularly novel thing. It's just at some point you're issuing such few Bitcoin per block that people find it more profitable to attack the Bitcoin chain and do reorgs and so on, rather than to continue to mine honestly. I haven't seen a solution to this in Bitcoin, and as far as I can tell, what is a solution to this is basically something like EIP 1559. Right? You need something that, so let me see if I can explain this. It's going to be very hard to keep a completely fixed supply asset in the long run, right? And the reason for that is like, well, there are going to be times where the market is really bad. And during those times, you need to not mint a whole bunch of Bitcoin or whatever your native asset is and, inflate the supply. But at the same time, in those times where the market is really bad, you kind of don't have a choice. The best you can do, you're going to have to inflate your supply somewhat, because you kind of need some value on to stay secure in those times. So what do? Well, when the times are really good, we just kind of offset that by buying back the native token off the chain and burning it, right? So this is what EIP 1559 is. I think this is basically the way that you make a chain secure. You make it a smart chain, so it's not a dumb calculator like Bitcoin. That allows you to encode some amount of economic value on top of the chain that is not just the native asset itself, but some like additional infrastructure or products that can be created. And then you have those pay homage to the underlying asset and basically be used in order to buy back the asset and reduce its supply when times are good. So, even if ETH weren't a purely deflationary asset, right? Let's say if you zoom out 20 years from now, it's kind of just like Bitcoin. It's just going to stay at some sort of finite supply, but it sort of goes up and down depending on the market cycles. That's sort of the worst case I think we could be in. And then what I think is much more likely is we're just going to end up in a world where ETH is net deflationary over a long time scale. Pending some stuff about how the L2s integrate on top of Ethereum and so on. But basically, you need an EIP 1559-like mechanism in order to solve this problem. Maybe there are other ways to do it. This is the one way I can see works today. And if Bitcoiners don't change their mind about this, I mean, if they don't change their mind about proof of work or the security fee issue, like basically proof of work is also causing them to have to issue a lot more tokens than they would if it was proof of stake, right? But proof of work is really valuable. It's much more objective than proof of stake in a bunch of ways. You kind of want the decoupling, the loose coupling between Bitcoin and the actual hash power. That's actually like a feature, not a bug. It's actually important that those are different. In the proof of stake world, where they are the same thing, you just stake the native assets, it's a bit more circular, right? There's some things you lose there. So Bitcoiners either, I think, are going to have to decide to move away from proof of work, which seems like it's pretty unlikely, or they're going to have to decide to somehow find an EIP 1559-like mechanism in order to allow them to do issuance that is non-zero in the long term, right? So that's basically how I see that. I think they're like in denial about a bunch of realities about blockchains, and I have not yet seen someone espousing a belief that doesn't make it seem like they're, how to say this? It seems like they know reality and they're denying it, rather than, if they were entirely open to how things could be, then they'd be maybe talking about like, okay, maybe this other way of doing things is important. But actually it's important for the narrative to not indulge any of that conversation at all, right? And that's what's unfortunate to me. I'd like to see a bit more conversation that didn't just delete the mimetic center of Bitcoin by, taking away, they're all centered around this "we will never change" ethos. So yeah, I'm quite bearish if there is in fact no change applied to Bitcoin over the next 50 years. I don't see there's any way in which the tiny issuance that we'll have in 50 or 100 years is going to be sufficient to keep the chain secure.
I'm going to keep my powder dry on this one. I'm not going to. I'm not going to go on record as saying anything at all. But
probably I shouldn't have.
Okay, well, we have come to the end of our questions, which is amazing. So, Taylor, thank you very much for being such a great guest, for going into great detail, giving him some amazing insights. And thank you, everybody else, to hopping over to Discord, a nice, solid, stable platform. And I guess thanks very much to Braden. And I think that's probably us. We've run now to an hour and a half of online time. So thanks, Taylor, for your extended time, and it's been great.
Great. Thanks for having me up here, everybody. And looking forward to, along with you guys, watching that mainnet dashboard as it creeps closer to 100%.
Yeah, sure.
Cool. Well, thank you very much, Taylor. Hope everybody has a nice day. Everybody in the United States, a nice Father's Day too. And we'll see you guys again soon enough.
Cool. Thanks.